Hi everyone, my name is Busari Abiodun. Welcome to my channel. In this video, I'm going to discuss about bank reconciliation statement. This particular topic is going to be in 4 sections, and this is going to be the first part of the tutorial, which is an introductory part. Bank reconciliation statement. Before we go into what the topic really is, let's take the keywords in the topic. We have bank, we have the word reconciliation, and we have the work statement, which is bank statement. So let's start with the bank. If we are talking about bank, a bank is a financial institution where money and other valuable items are kept. Which means when we are talking about bank, it's not only money that can be kept in the bank. There are other items that can be kept in the bank. Valuable items like property documents can be kept in the bank. Even academic certificates can also be kept in the bank. But for the sake of this topic, we are talking about the monetary aspect of a bank. So how does a bank record transactions? So when money is received into the bank is going to credit the account of the customer. Remember when I was talking about 3-column cash book? In the cash book, when the business receives check, they will debit the cash book. When they issue out check, they will credit the cash book. But in the case of the bank, reverse is the case. When bank receives check on behalf of the business, they will credit the account of the business. But anytime the bank is making payment, that is when money is paid out, the bank will debit the account of the customer. That is how transaction is being treated in a bank. Now, the word reconciliation. So the word reconciliation arises when there is disagreement between the bank and the cash book. That is the bank statement and the cash book. Then the next thing is that they think about how to reconcile the two books. So that is, if you are talking about reconciliation, it means to bring to an agreement. So this mostly occurs when the bank balance in the cash book is different from the balance that is that appeared in the bank statement. For example, the bank balance in the cash book showed a balance of 210,000 naira. So which means the business believed that, okay, they have 210,000 naira in bank. But by the time the bank presented the bank statement showed an amount of 185,000 naira, a whole 25,000 naira difference. Where is this money hiding? So that's the question. So that is the essence of the reconciliation, bank reconciliation statement. To now reconcile, to know the differences, to bring to the agreement, the disagreement between the two books. Now, if we are talking about bank statement, this is a statement issued by bank at a regular interval. It may be monthly, it may be quarterly, it may be yearly, which provided this information about all the transactions, that is all the deposit into the bank and all the withdrawal being made from the customer's account. So this statement is issued to the business. We call this statement bank statement. Now, bank reconciliation statement, which is the bone of contention. If we are talking about bank reconciliation statement, this is a statement prepared by the business to reconcile or to bring to agreement the differences between the bank balance in the cash book and the bank balance in the bank statement. There is a disagreement between the two. So the statement we prepare to bring into the agreement, we call it bank reconciliation statement. Just like I said earlier, the balance in the cash book showed a balance of 210,000 naira. The balance in the bank statement showed a balance of 185,000 naira. We now prepare the statement to bring the differences into an agreement. So now the next thing is, what are the causes of disagreement? What are those things that led to the disagreement between the cash book and the bank statement? I'm going to list these causes one after the other before I discuss them in detail. The first one is unpresented check. We have uncredited check, standing order, bank charges, direct debit, direct credit, dishonored check, dividend received, and errors in the book of account. Let's start taking these causes one after the other. We have unpresented check. So this is a check issued by the business to suppliers or a third party, maybe that the business purchased items from, but the check has not been presented to the bank as per the time the bank prepare the bank statement, which means such amount will not be captured in the bank statement. So we call such a check unpresented check. And what will be the effect? The effect is that the balance in the cash book will be less than the balance in the bank statement. We've already issued the check to supplier to go and withdraw the money from the bank, but the supplier did not tender the check earlier. So as a result of that, the amount we will be having in the bank will be more than what we thought we are having in the bank. Uncredited check is the opposite of unpresented check. This occurs when the check is received by the business and the check is presented after the bank statement had been prepared, which means we receive the check, we debit the cash book, so we tender the check to the bank for the bank to credit our account. But by the time we presented the check to the bank had already prepared the bank statement, which means the amount will not be captured in the statement, but the subsequent statement. So such a check is called uncredited check. And what will be the effect? The effect is that the amount in the cash book will be greater than the amount we will be having in the bank statement. So if we are talking about bank charges, as we know, this is the amount charged by a bank for its services. Bank will receive money on their behalf, they make payment on their behalf, they help the business to keep their money. All these services are not being rendered free of charge. The bank will charge the business at the end of the period for those services. Without informing the business, they will withdraw the money directly from the account. So as a result of that, there will be difference between the balance in the bank statement and that of the cash book. The effect of this is that the amount in the cash book will be greater than the amount in the bank statement because certain amount has been removed from the business account without informing the business for the bank services. Direct debit. If you are talking about direct debit, this occurs when bank makes payment directly to a person or firm who has been authorized by the business to make such payments on their behalf. A good example of it is electricity bill. We know at the end of the month, electricity bill, there will always be payment for electricity. And as a result of that, the business has already instructed the bank to always make the payment each time the bill is being presented. So such payment will be made without informing the business by debiting the account of the business directly. That's the reason it is being called direct debit. And the effect of that is that the balance in the cash book will be greater than the balance in the bank statement. If you are talking about direct credit, it's the opposite of direct debit. That is when money is being paid directly into the business account without the consent of the business. So this occurs when money is paid directly into the company's bank account. Such amount is credited to the account. And a good example of it is dividend. But we all know what dividend is. That is the share of profit from other businesses that the business invested in. So the effect of it is that the balance in the bank statement will be greater than the balance in the cash book because the bank has already received some certain amount of money in addition to what is in the bank before, which has not been added to the cash book. Dishonored check. If you are talking about dishonored check, this occurs when a check received by the business or a check issued to the customer is being rejected by the bank. The business received the check, they debit the cash book that they have received the money, they tender the check to the bank rejected the check, which means the money will not be added to the balance and the bank. As a result of that, the amount that will be in the cash book will be higher than the amount that will appear in the bank statement. And the opposite also is that when the business issued check to supplier or when they issue check when they make purchase and on getting to the bank, they tender such check, but the check is being rejected. It means the money will not be deducted from the business account, whereas it has been deducted in the cash book. The effect of that is that the amount in the cash book will be overstated. So in the case of check received, when they receive check, it means the amount will be greater than what they have in the bank. In the case of check issued out, the amount will be understated because they will have deducted the money from the cash book, whereas the bank has rejected it, has not made the payment of the business behalf. So the balance in the bank will be greater than that of the cash book. Dividend receipt. I explained dividend briefly earlier. If you are talking about dividend, it is the share of profit received by a company or an individual for its investment in other companies. So this share of profit is what you call dividend. So and the money is received directly into the bank account without the consent of the business. The effect of this is that the amount of balance in the cash book will be less than the amount of balance in the bank statement. While lastly, the one we will be discussing is errors in the book of accounts. If you are talking about errors in the book of accounts, this may occur when entry is wrongly being entered in the book of accounts or errors being made in balancing up the account. If you are talking about entries being wrongly made, that is the amount appeared in the check is wrongly recorded in the book. That will affect the balance and it will cause disagreement between cash book and the bank statement, or in balancing of the account and in adding up the values in the account. If there is any error in that process, it will cause disagreement between the cash book and the bank statement. So this can happen to the business, this can happen to the bank. So whichever it is will determine how such errors will be corrected. So just like I said, so that is the end of this particular tutorial. Until the next video which I'll be recording, don't forget to subscribe to this channel, like the video, share with others, and you can also join us on Facebook by following us on Simplification of Financial Accounting Tutorial SOFA page, or you visit my website sofaaccountingtutorial.blogspot.com. In the next video, I will be taking an illustration on Fado Enterprises cash book, which showed a debit balance of 11,000 naira, but upon presenting the bank statement showed a balance of 1,000 naira. 11,000 naira to 1,000 naira, a whole 10,000 naira disappeared. So what are the causes of this disagreement? How are we going to treat this? So these are the things I will be discussing in the next video. So don't forget, like I said earlier, to subscribe to the video, like the video, and share it with others. Until the next lesson will be meeting, I said bye for now.